Good evening. This is Duane Lowry for the DPP Grain Desk on Sunday, October 20th. Tonight, we're going to talk a little bit about tonight, but I want to look forward to the next several weeks, few months, and try to analyze what producers need to be doing with unsold inventories. As far as tonight is concerned, we're looking at relatively quiet activity. Probably could easily trade on both sides. Any weakness tonight will be very well supported, and there are reasons to think that we're going to have short covering activity develop this week. On Thursday, we get an export sales report. That'll be the first export sales data we've had since data that reflected the week ending September 26th. There's been Chinese demand or purchases of U.S. corn. There's been presumably a lot of soybean business done. And I think there's a certain amount of headline risk that the bears will have going into Thursday's export sales report. Technical conditions are supportive. Price action was pretty firm or supportive last week in all the markets. And I think that you're going to see pressure on shorts to build as the week unfolds. So to the extent that we start this week on a quiet endeavor and maybe trade slightly lower, who knows. I think that's going to quickly change as the week unfolds going into Thursday. I think there'll be a lot of pressure for short covering activity, and I think the markets will be well supported. Looking ahead over the next few months, how much of a price rally can we expect here? I think it's fair to say that crop yields in the U.S. are better than expected, better than late season August weather suggested it would be, better than early season, late planting, and all the problems associated with that would have expected it to be. And I think that we have a situation here where supplies in corn are certainly going to be plentiful. Supplies in beans are going to be adequate. And when you look ahead to South American production, they're going to be expanding acres. If they have a normal crop, you're going to have very burdensome supplies from a global perspective. Wheat is going in the opposite direction of corn and beans. We're not building and adding to stocks. We're seeing declining stocks, but to what extent there's price strength potential remains to be seen. So I think when producers are looking at their options for excess inventory, unpriced inventory, and I think producers have largely made up their mind they're not going to make sales this fall, with the exception of that possibly being soybeans. So the producers are going to have a lot of unsold inventory as they finish up harvest here. I think producers need to look at possibility that upside potential. While I think we can have some short covering activity here and we can have some certainly notable price strength over the next few weeks, that price strength might be limited to 20 to 40 cents in corn, which will get July futures up towards the $5 area. They're currently at about $4.70. You might be able to get these futures up to $4.70, $4.75. They're currently at about $4.40. So you're talking, 30 cents on the upper end of possible parameters. If that is true, and you're able to get July futures towards $5, what is the downside risk? If you make sales or hedges, what are you trying to protect? We just had these futures trade in the low 430s. It would not be unreasonable to look at supply demand, look at possible price pressures, and contemplate a scenario where futures, corn futures might be worth $4. So when you're looking at $5 hedges, 25, 30 cents up from where they're finished on Friday basis July futures, you're trying to protect against a scenario where corn prices erode and erode and erode, and they find limited reasons to have sustained rally. They might be supported because of Chinese demand. They might be supported, but all this supportive activity is occurring in a sideways to drifting lower type of market atmosphere. And what you don't want to find out is you end up going into spring faced with large unsold inventories. So I think over the next let's say the next 2 to 4 weeks, we're looking for some sort of price recovery. At that level, you're looking to make sales, forward contracts, hedges, depending on basis in your area, you determine whether you can get a good cash bid or whether you're looking at hedges. But your downside risk here is a sideways price erosion activity with limited sustainability of short-term rallies, and that lasting into the spring season. So I think that's what you're trying to deal with. As far as wheat is concerned, wheat performed well last week. Over the last few weeks, wheat's rallied 70 cents, 80 cents off the spot continuation low. Further upside potential is probably limited for several reasons. There might be a declining global carryout levels. There might be some trouble spots globally, but the scope of these problems could be debatable. And I think that when you look at wheat-corn spreads the way they are right now, it's pretty tough to be bearish corn and bullish wheat at current levels. It's pretty tough to be expecting significant upside potential in wheat, but expecting limited upside potential in corn, and yet that's kind of what the trade sentiment is. The trade is still very short corn, very bearish corn. I think too bearish, I think too short. I think they're vulnerable to a short covering activity. The last month we've been in a very small range, and I think that we are gravitating towards the upper part of that range, but the range is so small that you have to ponder how significant this gravitation up has been. That being said, there are reasons to expect short covering activity, and I think that we still get that. As far as wheat is concerned, you got long-term resistance developing probably 15 to 35 cents higher than where it is now, and I think that you've got resistance developing in new crop wheat at about the same levels. So the wheat, while it's been impressive and it's rallied 70, 80 cents, further strength potential does exist, but it's going to run into longer-term resistance. It's going to run into hedging activity on the producer level. You're going to have long-term bears looking to make sales, and you might have people trying to still pick a top in the intermarket wheat-corn spreads. So wheat has limited upside potential over the next few weeks. It has some upside potential, but limited. Corn, same situation. We've already talked about that. As far as soybeans are concerned, some upside potential develops here, but you've got long-term resistance technically 25 to 40 cents above where it finished on Friday. You have fundamental backdrop that is the better than expected yields in the U.S. have probably pretty much removed the potential for a significant rally in beans unless you can get a problem in South America. You're going to have expanded acreage in South America. You're going to have a situation, minor problems in South America will probably not be well responded to by the marketplace because of an overall large global supply expectation. And so you've got, over the next few weeks on short covering activity, corrective strength type of thing, maybe you've got 25 to 45 cents upside potential in beans. But here again, the producer needs to be looking at such type of short-term strength to hedge unsold inventory, because over the next several months this is probably not a situation where you want to have a lot of unsold inventory. As far as what is the downside risk here in soybeans, I think you have to respect the risk for spot futures to trade 11.50 or less, and currently you're trading approximately 13. If we can get some short-term price strength as expected, you're going to get an opportunity to sell something better than 13 futures, even in the the Jan or the March contract. I don't know if you'll get July futures to $13 or not. They're like $12.50 right now, but you're going to get something up into that zone. So downside risk from those levels, you've got to respect $1.50 or $2 over the next several months. I think that's enough of a downside risk that warrant activity on further price strength. So just to be clear, I think short term we have some price strength, but on the longer term, bigger picture perspective, that price strength that unfolds over the next 2 to 4 weeks needs to be searched by producers for longer term pricing and hedging opportunities. I don't think the next several months we have the type of situation that should make you feel comfortable holding unpriced inventory with no plan in place, no hedges in place, and things of this nature. I think you could find yourself quite disappointed in pricing opportunities. So I would look at using the DPP grain desk platform, put some offers in for sales above the market, 15 to 35 cents in corn. Those are reasonable targets. I think they're attainable. 20 to 40 cents up in beans. I think those are reasonable targets. I think they're attainable, and I think you've got somewhere between 2 to 4 weeks here for those type of rally events to unfold and get those pricing done. So for the DPP grain desk, this has been Duane Lowry. Thank you.